Macroeconomic news events in trading. What is it and why should you care about it? Now let me start off by saying I do not trade news. I used to trade news when I was a futures trader, but I don't anymore. And as a proprietary trader, I don't think you should either. So what's the point in really talking about it? Well, in trading, ignorance is no excuse. And when things have market effects or market impacts, it's your duty to be aware of what these things are, when they happen, and what kind of effect they might have on the market or any open positions you may have. Now, if you're trading on your Maven account and you have trades open through the news, that is perfectly acceptable. What is not acceptable, however, is placing trades and trying to get in line with the news just to try and effectively gamble on the news results. So let's talk about the types of event risk that are going to have an impact on the market. There's pretty much 4 different types of event risk that you're going to need to look out for in the markets. The first is low impact. On your economic calendars, this is going to be displayed with a yellow icon, and the impact in the markets is so negligible that it's not really even worth talking about. Next up, you're going to have medium impact, which is going to be denoted with an orange symbol on most economic calendars. This tends to have somewhat of an impact, but again, unless you're a scalper or something like that, even medium impact, low impact really aren't going to have much of an impact on your trading. Now, the next type of event risk that you should be aware of is high impact event risk. This is always going to be displayed with a red icon on most economic calendars. These are huge data events like the non-farm payrolls, which is employment data in the US, CPI releases from different countries, whether that be from the UK, the Eurozone, the US, Canada, etc. CPI is Consumer Price Index, a very good benchmark for inflation and a big market mover. You're also going to have things like ECB or FOMC meetings. You'll see ECB speakers and Fed speakers and that kind of thing. These are central banks meeting together to speak about policies and to release announcements and that kind of thing, and these tend to be large market movers as well. Now, the fourth type of event risk is almost impossible to prepare for because that is unscheduled event risk. So this would be events that don't appear on any economic calendars but simply come out, whether you see that on your Twitter feed or it gets released somewhere on FX Street or Forex Factory or something like that. It's not been expected, it's not been scheduled, but it has a large market impact. For those of you who've been trading for a little while, you will remember towards the end of the pandemic, companies like Pfizer, Moderna, or AstraZeneca released their vaccines. We saw large market impact when those vaccine comments came out. Basically, representatives of these companies came forward to say, we have produced a vaccine that is this effective, and of course, this led to large market impact. Some other surprise data that won't be on the calendar would be things like surprise interest rate hikes coming out of banks. We sometimes see surprise interest rate hikes from the Bank of England, for example. Again, that's going to be a huge market mover, but very, very difficult to prepare for. So now that we know what kinds of event risk we're looking out for, why should we look out for these calendar event risk or even unscheduled event risk if we don't make trading decisions around it? Well, first and foremost, it is essential that we're aware of anything that could be impacting the markets we trade. You could find yourself in a position on gold or on the euro dollar, at 1:15 on a Friday evening, first Friday of the month, and within 15 or 20 minutes, that position that was running quite a nice way in profit, you hadn't secured any profit, you hadn't moved your stops or anything like that, within 15-20 minutes it's completely reversed and taken you out because the NFP has come out and it's gone against you. These types of calendar event risk that we've spoken about before, NFP, CPI, etc., the result of that event risk coming out has a direct impact on the currency affected. So for example, when the NFP comes out on the first Friday of every month, what do we see? We see the unemployment statistics for the previous month in the US. Now, if those unemployment statistics come out relatively poor, what we're going to see is a weaker US dollar. So we must be mindful of the event risk that's coming out so that we can trail stops, even exit positions if you want to secure some profits, or just avoid trading on that day altogether. Now, something else that we need to be aware of is that with this increased volatility, we can also experience slippage. Now, if you're unaware what slippage is, if you're unfortunate, one day you're going to experience it firsthand. In my years of trading, I have experienced some horrendous slippage. Slippage is simply when the market hits your order, whether that be a limit order to get into a trade or whether it be your stop loss, take profit, etc. And because of the volatility of the market, because the market's moving so fast, you don't get filled where your order was. Now, there's liquidity and all this kind of stuff that comes into it, but you don't really need to know all of the finer details. What you do need to know is that when the market is very volatile, your chances of having your order slipped increase dramatically. So just as an example, example, you may have your stop loss set here. On the news, that market may come down, hit your stop loss, but you could actually get filled a number of pips below your stop loss. So you may go into a trade aiming to risk 1-2% perhaps, and you could come out of that trade having lost 3-4 even more percent. And you could come out of that trade losing double or triple what you'd intended to lose because your stop loss order had been slipped. I've experienced this firsthand. It is not nice, and I like to avoid that kind of thing as much as possible. Ultimately, in our trading, we want to apply our strategies, we want to apply our technical principles and systems in a consistent and in a conservative manner. And when news events come out, all this does is adds in another factor that we need to consider. All it does is brings in uncertainty. We know our strategy works over time because we have tested it. Bringing news events into the picture simply adds another factor that we have to worry about, which could affect the end result of our trade. So where can we observe this news? Where can we plan for this news? Well, there are a number of different websites that we can use online absolutely for free to be able to see what economic data is coming out in the days, weeks, and even months ahead. My top recommendation would be Forex Factory. Forex Factory, you will find news as it comes out, but you'll also find an economic calendar, which I like to check at the start of every day. FX Street also provide an economic calendar, which is very useful, and so do My FX Book. If you have My FX Book open, they even send notifications directly to your desktop browser to make you aware of news that's coming out. Now, on these economic calendars, you will see a forecasted result for the data, and you will also see the actual result when it comes out. Typically, if there's a large disparity between the actual result and the forecasted result, we will see a larger market move. If the actual result when it hits the markets is very similar to the forecasted result, typically we'll see less market movement because it was already expected. Now, typically when we're going to see the biggest moves off of the back of event risk is when the forecasted number is very positive, but the actual result is very negative, or vice versa. The larger the disparity between the forecast and the actual result, the larger the market move. Now, on all of my trading floors, I always had a squawk system. You can get a squawk system relatively cheaply, somewhere between 20 and 50 pounds per month. There's a variety of different websites you can find those on, and what this will allow you to do is to listen to the news live being read to you through the speakers, whether it be speakers on the trading floor like we had, or just speakers from your computer. You will hear the news being read live as it hits the markets. Very often with a squawk system, you will get the news before it gets updated on the economic calendar. When we ran our trading floors, we always had the squawk system on. This simply allowed traders to be aware of news as it was coming out. Things like these unexpected news events, the vaccine comments, etc., or surprise interest rate hikes would typically come out on the squawk before they would reach Twitter or before they would reach Forex Factory, FX Street, etc., etc. So even though I don't recommend trading news, having an awareness of the news, what's coming out, when it's coming out, and what market impact it's likely to have is going to help you prepare for those events, whether that means just standing aside for the day or whether that means trailing stops, locking in profit, etc., etc. That concludes this video on event risk. Drop this video a like and consider subscribing if you haven't already, and I'll catch you guys in the next one.